Hello students, welcome back to our channel. Today we are going to explore one of the most important chapter in class in economics, money and credit. Before we are get into the lesson, I have a question to ask you. Have you ever thought what would happen if there was no money in our society? How would you buy things? How would you sell? Let's find out how money came into existence, how it made trade easier, and how credit plays an important role in our economy. So, initially, before the money was invented, people used the system, which means goods were exchanged for goods. That system was called as barter system. For example, a farmer who had wheat could exchange it with a potter for pots. But there was a big problem in it. The system worked only when both parties needed what the other had. This is called double coincidence of wants. Can you imagine how difficult it was? If I want rice but the rice seller does not want my apples, the exchange can't happen, right? So, to solve this problem, people started using money, something that everyone would accept in exchange for goods or services. That's what money became the medium of exchange. Now, you don't need to find someone who wants your goods, right? You can sell your goods for money and buy what you need later. For example, a farmer sells wheat for rupees 2000. He can use that money to buy cloths, seeds, or anything else he needs, right? So, now we are going to see about the different forms of money. Let's see how money evolved over time. In the earlier or in the ancient period, the people used valuable metals like gold, silver, and copper coin. Later, government started issuing paper currency such as notes and coins. Today, most money exists in digital form in bank accounts, right? People make payments using checks, debit card, credit card, UPI, or online transfers. So, money today is mostly digital, not just notes or coins. In India, the Reserve Bank of India issues currency notes on behalf of the central government. No other individual or organization is allowed to issue currency. This ensures uniformity and trust in the value of money. It is authorized by the government. Everyone accepts it as a medium of exchange. Now that we understand money, right? Let's see how banks use it. When you deposit money in a bank, do you know what the bank does with it? People, how bank is working? Okay, let me see. People deposit their savings in banks. Banks keep a small part of the deposits as cash to meet day-to-day withdrawal demands. In India, banks keep about 15% of their deposits as cash. The rest of the money is loaned out to those who need money, such as a loan. For instance, if rupees 100 is deposited in the bank, okay, as we knew very well, 15 rupees is kept as cash and the rupees 85 is given as loan. The bank charges interest on these loans, which is higher than the interest it pays to the depositor. That's how banks earn profit. Okay, as we know that banks are giving loans, right? Banks give loans to whom? To farmers for buying seeds, fertilizer, and to small businessmen to expand their shops or business, even for house buyers, students, and many other persons. In the students, in the case that student education loan, but not everyone gets a loan easily. Banks check their ability to repay. Those who are getting the borrower's ability to repay, they used to check the borrower's ability whether they can able to pay, like that. Okay, so from this there are two benefits of deposit in the banks. One is that to keep money safe. One is that they are earning profit or they are earning interest. Okay, so banks help both depositors and borrowers. Now let's learn what credit actually means. What is credit? Credit means an agreement where the lender gives money or resources to the borrower with the promise to repay later, usually with interest. But credit can have two sides. One is that it can help a person to grow. One more thing is that it can also push someone into trouble. So, to make this concept clear in your book, we have two examples. Let me see that. One is positive, one is negative, right? So, first, let me see the positive side. Let me go into the positive side. Credit helps, I said. Credit helps. So, here there is a shoemaker whose name is Salim. Okay, Salim has a small shoe making workshop. He gets an order for a large number of shoes from a big trader. He does not have enough money to buy raw material, so he takes a loan from a bank. He completes the order, sells the shoes, and earns a profit, and he easily repays the loan. Okay, so here in this situation, credit helped Salim to expand his business and increase his income. The second we have seen, it has also disadvantage. Na? So here there is a farmer name called Swapna. So she is a small farmer, borrows money from a money lender. So here you want to understand the word from whom she is borrowing. Money lender. Okay, to grow crops. Unfortunately, her crop fails due to pest. She couldn't repay the loan. Okay, she cannot repay the loan, and the money lender forces her to sell part of her land. So here credit created a debt trap. Debt trap is nothing but ones who couldn't able to repay the money, they used to lose their property. So in that way, she lost her land and income. What is the conclusion we want to understand here is nothing but credit is helpful only when it is used for productive purpose and when the borrower is able to repay. Okay, otherwise it can become a burden. Okay, every loan has actually certain conditions. That conditions are called terms of credit. It is one of the important question, terms of credit. So terms of credit includes, okay, interest rate. Interest rate means the rate at which interest is charged. Second thing, collateral. Collateral is nothing but an asset offered as security for the loan. Third one, documentation. Papers and proofs required. Fourth one is nothing but mode of repayment. How and when the borrower will repay. So to make you to clarify this concept, here I come with an example. If a farmer borrows rupees 1 lakh at 12% interest per year and pledges his land as collateral. Okay, these are the terms of credit. That interest rate, okay, document nothing but collateral. So how he is going to pay the amount? How is he going to pay the amount? Okay. So here the collateral is very important to get the loan from the formal sector. When a person approaching informal sector, he does not require any collateral. Informal sector is nothing but we will see in the upcoming topic. First, let me see what is meant by formal sector. Formal sector includes banks and cooperative society. They are under the control of RBI. They charge reasonable interest rate and follow legal procedure. Who? Formal sector. Okay. So if it is informal sector is nothing but it includes money lenders, traders, landlords, friends and relatives. These are not regulated by any organization. They often charge very high interest rate. So here they didn't have any, actually they use not they will not maintain, they won't maintain any records at all. Okay, so these are the problems that are faced in the informal sector. One more thing you need to understand, if it is informal sector, they were not under the control of any supervision. Okay, one more is that interest rate used to be somewhat reduced and it will be increased in banks. It is fixed actually. In banks and cooperatives, interest rate is fixed and it is low. If you see in money lenders, it used to be very high. And the collateral, definitely it is usually required under for the banks and cooperatives. But for money lenders, it won't. They may or may not require. What may or may not require collateral, may or may not require for money lenders. Okay, so here, because of the distribution of credit in India, most poor households depend on the informal sources as they can't provide collateral or documents. Richer households and large farmers get loan from formal source because they used to have the collateral. This leads to inequality in access to credit. So the government should concentrate on the improvising or implementation of so many banks in the rural areas for the accessing of farmers. Okay. The last topic of this lesson is nothing but self-help group. Okay. So here, as we have already learned that self-help group are small group of people. Usually women used to there who come together to save money and support one another financially. Okay. So here, let me see somewhat more about it. Okay. So how this it is actually working? Actually, a SHG consists of 10 to 20 members. Most of them were women, often women only, from similar economic background. They used to meet regularly, either weekly or monthly, and each member contributes a small savings amount per month. It might be 50, 100, it is based on their savings. So these savings form a common fund which can be used to give small loans to the members who are in the group, pay for medical expenses or weddings, or even they used to invest collectively in small enterprises like dairy, tailoring, and puppet making, handicraft, this and all they used to make by using the money which they are saving. Okay, which are they saving? After a certain period, usually it might be 6 months to a year, if the group has maintained discipline and regular saving, banks provide loans to the group without demanding individual collateral. Actually, this SHE group is tied with the bank does not require collateral from this group. Okay, the system is known as microfinance because it provides small financial service to poor household. What is the main objective of SHG? It encourages saving habits among rural family. It provides easy access to credit, especially to women and poor household. It reduces dependence on money lender. So the interest rate in SHG is very low when compared to the money lenders, and it built confidence, leadership quality, and unity among rural women, promotes small scale entrepreneurship in villages, and even real life because it enrich the actually it supports the women growth. We can say women empowerment also we can say. So now I am going to give three real examples for SHG. One is from Kudumbasheri in Kerala. So this is one of the most successful SHG movements in India. It was started in the year of 1998 by the Kerala government to empower women. Millions of women are part of Kudumbashri actually. They manage canteen, beauty parlor, agriculture group, and even supply vegetables to schools. So actually in every state the SHG is there. Okay. So if another example for you from Andhra Pradesh. So here they used to call it as development of women and children in rural area, encourages women to form SHG and start income generating activities. Many women here started poultry farms, dairy units, and tailoring business. Okay. Actually, this SHG are not just about money. They are about social and economic transformation too. Okay. Even it supports for the economic benefits also. It helps a small farmer, it increase a family income and reduce the poverty. It creates a self-employment in villages actually. In social benefits, if we see, means it improves the decision making power among women, promote literacy, awareness and cooperation. Even SHG help in solving local problems like sanitation, education, domestic violence at all. Okay. So that is about the money and credit. I think so you have understood. So at the end of this video, I have attached questions.